Hi, in this video I'm going to show you how to create an interest-only loan amortization schedule in Excel. Interest-only loans are risky. They're the things that they say contributed to the housing crisis or the market collapse in 2008. They are risky, but they do have some uses. Say, for example, you just graduated from medical school and you know that you can't afford the house right now, but in 5 or 10 years you can in the neighborhood that you want. You could use an interest-only loan to get into that neighborhood in anticipation in 5 or 10 years you'll make enough money as the hotshot surgeon to pay off or pay for that interest plus principal loan. Or another scenario, let's say you've got a stock portfolio and you know that stocks will go up in the long term, so you don't want to sell it now, so you take out an interest-only loan and in 5 or 10 years you can sell your stock portfolio and maybe pay off that loan. The key is you have to know when loan is due and what amount at that time you're going to pay more of, and that's where a calculator or amortization schedule comes in handy. And Excel is the perfect tool to do that. So let's see how we can use Excel to create our own interest-only loan amortization schedule. So in this video, I'm going to cover 3 interest-only type of scenarios. One is where you pay the interest for a set period of time and then there's a big payoff at the end. You have to pay off the loan amount. Another one where we have a fixed rate interest-only loan, maybe a mortgage loan. And the third one, which I don't have here a tab, but I'll be building that out, is the adjustable rate mortgage. They ARM like a 3-1 or 5-1. In this case, I'll do a 10-1, an ARM 10-1 interest-only loan, and we'll see how that gets built out. So let's see what we have with the interest-only payoff. So in this situation, we're only paying the interest for 12 months. I'll put this on for a year, and then at the end, we have our payoff at $100,000, and we're only paying interest. And this is actually fairly easy to do. Let's delete this, and I'll show you how we'll build this out, right? And so if we wanted to build this out as a template, if we were doing $100,000 at 3.5%, the 3.5%, we're going to have to divide that by 12 because it's going to be 12 monthly payments, right? And the interest-only duration, I like to kind of add this one too, even though I'm not going to really be using it, but we're going to have that times 12, 1 year, it's 12 months, right? And to build this out, you can always do 1, 2, 3, and select that and build it out. Draw down and you'll see it count. But in this case, maybe we can do something a little bit different by having it fill series. All I need to do is type 1, press Control Enter to stay in that cell, go into Home, go to Fill Series, and the series is in columns, and maybe I want to stop at 13. Here, click OK, and it fills it out kind of nicely for you, so you don't have to do all of that. It helps when you have a much longer series of data, and that comes into play here when we do this one. And it's a nice little feature in Excel. So here with interest, we're just basing it on the interest, right? The amount that we are trying to get a loan for, F4 to lock that in is the absolute cell reference multiplied by the monthly interest rate because we're doing it by month. F4 that to lock that in as a absolute cell reference. Press Enter, and we can see here our interest is $291.67. Drag that down to the 12th month because we're going to be paying that. Of course, for principal, since this is an interest-only loan, we're only going to be paying interest. So principal is going to be 0. Press Control Enter to fill it out for everything here. And the payment, of course, that's the sum of these two. Select that. Oops. Select that just for month 1. Press Enter. And we're going to fill that down here. And of course, at the end of 13 months, you're going to be paying that $100,000 as a balloon payment, right? And so that kind of fits there. And our payment here at our 13th month, you bring it down here, that sum function. That is our $100,000, which is the balloon payment. And this is actually fairly easy to do. I mean, you don't really need to put too much effort into creating something like this. Now, the key here is when we start to do interest only and we have our fixed rate, which is our next example. Let's go to the next example here. And here we're in our next example where we have an interest-only loan and our interest-only period is for 10 years. So the rest of it, this is a 30-year loan, 10 years is the interest-only portion and 20 years is the rest of it where we're going to pay interest and principal. So this is how it gets laid out. We've got our interest here, we've got a month column, an interest only or month number column, and then this is going to be used to help trigger whether or not we're going to be paying interest or interest and principal, right? So we're going to use this in other functions to do that. We have our balance, payment, interest paid, principal paid, and our new balance. Let's see how we lay this out. And I'm going to delete everything here. Control down arrow again, and we'll just right click delete. So everything gets deleted. And we're going to start out with this first row here. This new balance is going to equal the principal here first, right? So once we fill this all out, that's where it's going to equal. Let me get rid of this and show you how this gets laid out to how I build this out. This is going to be equal to that divided by 12, right? And then of course this is the same. There are 30 years multiplied by 12, which is 12 months out of 12 months per year. Of course, it's 360 months. Drag the fill handle down here. It will copy the formula down, and that kind of lays it out for our calculations that we're going to use down here. Our interest is going to be based off of this, right? Divided by 12, right? And for the fixed rate interest only loan, what's going to happen is we have a fixed period of interest is 10 years, and after 10 years, it's going to be at that same interest rate where you're going to pay interest and principal. Basically, it's going to double in a way when you think about it. So we have our interest here, and our month, this is going to be the first month. Press enter. And I'm going to fill this one down with the fill series that I showed earlier. And you can see how the magic happens here, right? So I have columns here. My stop value is going to be 360, right? 360. Click OK, and you can see it filled out everything down there. Control down arrow brings me down there to 360. Control up arrow brings me back up there. Now for this, I'm just going to double click the fill handle. It's just going to copy that down, and I didn't copy it down correctly because I didn't have an absolute cell reference. Let me do an absolute cell reference there. Control Z to undo. This I need to press F4, so I have the dollar signs in front of the C and the 2. Press Control Enter to stay in that cell. Double click the fill handle, and it copies that formula down, and it stays as an absolute cell reference, right? Here for the interest only, I need to bring in a formula that looks at this number, this month, and sees if it's less than that. If it's less than 120, it's going to say it's an interest-only loan. Otherwise, it's going to start a new month number. Now the formula or combination of function I'm going to do is going to be an if, open parentheses. If this cell is less than or equal to this 120, press the F4 key so I can make that an absolute cell reference. If that's less than 120, then that is going to say interest only. So if it's true, it says interest only, right? And if it's false, this value minus that again, absolute cell reference, close parentheses, press enter. You can see it says interest only here. Double click the fill handle to copy that formula down. Once I get to 121, if I go here down to 121, you can see it stops saying interest only, and it starts to count the month when that's the first month where it's going to be interest and principal. So let's go back up, control up arrow to go back up here. So now I've built out this column. The next column is our balance, and this is basically going to equal the previous balance from the previous period. So press enter or control enter, should have stayed in that cell. I'll double click the fill handle to bring that down. Of course it says 0 because this line here is not built out yet, so it's going to say 0. Now we're going to get to the little bit more complicated part, the payment area. And this is where we're going to look and see if this says interest only, we're only going to look for the interest paid column. If not, then do a calculation of the payment based off of all these other parameters. So here we're going to type equal if, open parentheses, if C10, this part, equals interest only, I have to put in quotes, interest only, close quotes. If that's true, comma, then what we want to do is just bring back this column, F10, because that's the interest paid. I'm going to build that one out later after this one. If it's false, then we're going to bring back the payment function. So I'm going to do minus PMT, open parentheses, and A10, which is my interest, my monthly interest here, and my number of periods is going to be C5, which is 240, right? So 240 is my number of periods because we're assuming that if it's false, we're out of the interest only period. That means that our payment function is off of the rest of that period, the 240 periods where it's going to be interest and principal. So we have to use that. And that's got to be a absolute cell reference because it's always going to reference 240 months. Comma, And what is the present value? Well, the present value is going to be this, right? The previous value. All right, so that's going to be $100,000. And that also needs to have a absolute cell reference. And I don't need anything else. Close parentheses, press enter. Whoops, I forgot to add another parentheses, and Excel is added for me. So click yes. And it says 0 because there's no value in here, but I'm gonna double click the fill handle to bring it down, and that will bring it down for the other ones. So let's get to the interest paid. So this is the interest that you pay on that $100,000, your balance, right? So this is going to be equals to D10, which is my value here, and I'll multiply that by the interest here. Press enter, and we have our payment. That's a bunch of decimal places out there. I'll fix that one later. And we'll double click the fill handle to bring that down. Of course, it's at 0 because there's no value here, because I don't have these columns built out yet. So principal paid, what is this? Basically, it's my payment minus my interest, right? So that minus my interest equals that, which is 0. And the new balance is going to be that value, my old previous balance, minus the principal paid, right? So I can just select these two areas and double click the fill handle to copy it down, and now we have our values here. And one of the reasons why we have our decimals here is because it's not in currency. So what I can do is I can take one of these. These are in currency. You see, it's a currency format. I can just use the format painter and apply it there, and double click the fill handle to bring it down. But you also notice if I bring it out a little bit, the decimals still show up. And so probably want to round this out, because it does do some funny things when we get down further along the periods. So I'm going to round it out to the second digit. Press Control Enter to stay there. Double click the fill handle, and you can see if I pull out, it rounds it out. Do the same for the interest paid, because you can see it does the same thing there. And I'm going to put that in a round function. ROND, open parentheses, comma 2, close parentheses, press Control Enter, and double click the fill handle. You can check, and it's rounded it out, right? And now what we see here is when we go all the way down to payment number 121, that's where it changes, our $100,000. Now we have our payment, which is pretty much double here, because it's now including the principal and interest. So that includes that, and it draws it down here, right? And we go all the way down. You can see that we get to a point here where it does a minus 11, because it's assuming that we're still paying $579.96, right? And then that might not be the case. You know, if you pay this payment amount, the bank will send you back a very small check. But in this case, when the bank knows that you are close to paying it off, they'll probably adjust that payment. And here, what we're going to do is we're going to do some if statements. This gets a little bit hairy. I'm going to do it down here, and I'll just copy it back up there, because it will suffice. So what I want to do here is I want to put in another if statement, right? So I want to say if the output of this whole thing is greater than this, then all we want to do is bring back the sum of this value and the interest, right? Otherwise, we will continue with that particular function, right? So I'm just going to copy this because I need it later on. Control C to copy, right? But I want to still use this in the first part of the if statement. So I'm going to say if that is greater than this value, if that's greater than this value, right? Then comma, I want to add this value plus the interest, that value, right? Otherwise, just do the same statement that I copied earlier, right? Just do the same thing. Control V to paste. Close parentheses, press enter. Now I have 579.85, which is basically that plus that, right? So that's 589 plus 85. And so then you get your 0, and you've paid off the principal, but you've also paid off that interest. So I'm going to take this value, Control C to copy, and then just bring it back up to the top. And then Control V to paste. You can see that the absolute cell references are copied as they are, but the other references that don't have a dollar sign, they revert it back to that column, right? So A10 is here. Earlier, it was probably A300 and something, right? Press Control Enter, double click the fill handle to bring it down, and now that formula, that big formula is always copied all the way down here, right? So I just press Control down arrow to bring it down here. And we have our formula here. So now we have our amortization schedule all built out. And so if we have any changes, maybe we change that to 4%. You can see everything changes here, right? And so that is kind of built kind of nice. So you can model it now with other changes like the interest rate or the interest only duration. Now that's for the fixed rate interest only scenario. What if we have an adjustable rate only scenario? Maybe we have a 5-1 arm that occurs after the interest only period, or a 10-1. So I'm going to use the example of a 10-1. So let me change this back to 3.5, and let's make a copy of this because it basically is the same thing, but you're going to have to do some manual adjustment. So I'll press the Control key, the left mouse button. I'm going to bring it here as a copy, and I'll call this adjust arm. So this is going to be the arm interest only one, right? Scroll back up and bring this all the way back up. Oh, one thing to notice that you can see that even when I scrolled, I had this kind of stuck there. That's because I froze that row. The way that you would do that is if you go under View, you go under Freeze Panes. If I unfreeze it, if I scroll down, you can see it disappeared. But if I wanted to keep everything 8 and above frozen, all I need to do is go Freeze Frame and Freeze Pane, and then that froze that, right? So let's get into a situation where it's not a fixed interest rate. That 3.5 is not fixed after the 10 years. Let's say it goes up every year, maybe to a certain percentage. And this is where the manual part comes in, because after 10 years, if you've got a 10/1, that means that the adjustable rate will adjust every year. That 1 means every 1 year it's going to adjust. So let's say, for example, it adjusts from 3.5 to 4.0 in the first year, and maybe the second year it goes to 4.5, right? In this case, what we need to do is we might need to manually adjust it, right? So if we go down to 120, so here I'm going to need to make some changes. There's probably 3 changes that I will have to make here in this row. First, I need to change the interest rate, and then I need to change some parameters within this function. So the second thing I need to change is going to be the number of periods. And in this case, in the first instance of it, might not need to change that, but in the second instance where the interest rate goes up to 4.5, I need to change that. The third thing I need to change is the reference to the new balance. In this case, at the first instance of the coming out of the interest only period, I don't need to change that. But when I go to the next change of the interest rate, maybe to at 4.5, I need to change that. So let's change this one first. Press Escape to get out of that. We're going to change the interest here first. Here we're going to have 4% equals 4% divided by 12. Press Control Enter to bring it down to execute that. Double click the fill handle so it copies that formula all the way down. You can see everything else changes here. I'm going to change it later on when we get to that after the 12th month. Maybe that after that 1 year it changes to another interest rate, but we'll get to that soon. Here I need to change this, oops, my payment value. That's got to reflect something different, right? So that C5, that 240 is fine, but in this case, let's just make it more explicit. We're saying that we are saying that we're doing 360. That's the total amount of payments here, and we're going to minus off 120, right? That's our period there. And you can see when you do that, 360 minus 120 is that 240. But we're going to use this later on for the second year, right? So we got to do the same here. That also changes because that's a carbon copy of this formula, right? So that needs to change. That's also 360 minus 120. And here in this case, I'm going to change the reference to the previous present value to the date above, right? The month above. That's this 120 here, right? So this is going to be 120. I really don't need to change it here in this case when you think about it because it's been 100,000. But I like to put that there because you think there's 3 things that we need to change because I'm going to have to change it at the 133rd payment here in row 142. Right. So that's got to be 129. Oh, I think I did this wrong here. This has got to be 129. That's the previous row there. Press Control Enter to stay in that cell. You can see that now it's changed to 605.98. Double click the fill handle to bring that down. You see that that's changed. And that's changed because our interest rate has gone up 0.5% to 4%. And that's in that first year, right after our interest only period. The second year after interest only period may be down here. Let me actually highlight this. So that now this is kind of something that we know that there's a change here. Now the second part is maybe it changes after that first year. This changes to 4.5. So I'm just going to put 4.5. Press Control Enter. and it changes that monthly rate. Double click the fill handle, bring that down, right? And here we also need to do that change here for the payment. So this is going to be 360 minus 132 because we're adding another 12 months here. 132, and this will be 132 here. And also here, we're changing it now. We're changing our present value. It's going to reference the new present value here. So that's going to be 141. So that's going to be, instead of 129, 141. We have 141 here. Press Control Enter, and we have our new value there. Double click the fill handle, and it copies the formula down, and we can just highlight this row indicating that that's a change, right? So every year it's going to change, and this will help you model it when you think about it, because you might have to model it. You might want to model it maybe 5 years out that it's going to change. Maybe it'll go up. Maybe you think it'll go up 1 year, and maybe you think it'll go down another year. So you'll model it after, and maybe you think you model it at another 12 months for a different interest rate, and you have to do the changes there. And this part's a little bit more manual when you think about it, but it still helps to give you an idea of your schedule after you come off the interest only period. And the first 12 months after the interest period only period is going to be at this rate, and maybe the following year it's going to be at a different rate. And later on, you can do different rates to kind of see where your payments are at. So that's the adjustable rate portion if we have an interest only type of example.
So creating our schedule in Excel is actually not too bad. It's not too hard. Once you have it set up, you can plug in any other variable in there, changing the interest rate or changing the term. And when you're shopping around for different loans, you can plug in the different numbers around and get an idea of what you need to pay and what to expect. So the key here for your interest-only loan is it's a short-term strategy or solution for you. As long as you come in with full expectations that you're paying less now, you can set yourself up for some flexibility and financial freedom in the future. So I hope that helps. Thanks for watching, and don't forget to subscribe.